Hello, this is Eric Hagen with the Plotter Podcast. It is the morning right now. I just got the kids on the bus, and it is a very cold late October morning here. End of the year is fast approaching. So I thought we'd take a look at some things that you might want to consider before saying goodbye to 2019. Hi, this is Eric Hagen. Would you like to know the secret to prosperity? Well, the good news is I have the answer. The bad news is it's not any one thing. The secret to prosperity is in every decision you make. The Bible calls it steady plotting. I call it common sense. Join me on this podcast as I try to inspire you to make your next financial decision and the one after that a good one. So what has changed for you this year in 2019? Did you start a new job, or maybe you left a job behind? Did you retire? Did you start a family? If notable changes occurred in your personal or professional life, then you'll want to review your finances before this year ends and 2020 begins. Even if your 2019 has been relatively uneventful, the end of the year is still a good time to get cracking and see where you can manage your tax bill and or build a little more wealth. And remember, this content is for informational purposes only and is not a replacement for real life advice. Please consult your tax, legal, and even accounting professionals before modifying particularly your tax strategy. With that, let's look at 7 things to consider before the year ends. All right, number 1. Do you practice tax loss harvesting? That is the art of taking capital losses, which means selling securities or stocks worth less than what you first paid for them, to offset your short-term capital gains. You might want to consider this move, which may lower your taxable income. It should be made with the guidance of a financial professional that you trust. In fact, you could even take it a step further. Consider that up to $3,000 of capital losses in excess of capital gains can be deducted from ordinary income. And any remaining capital losses above that can be carried forward to offset capital gains in upcoming years. When you live in a high-tax state, this is one way to defer tax. All right, number 2. Do you want to itemize deductions? You may just want to take the standard deduction in 2019, which has ballooned to $12,200 for single filers and $24,400 for joint filers because of the Tax Cuts and Jobs Act. If you do think it might be better for you to itemize, now would be a good time to get the receipts and assorted paperwork together. While many miscellaneous deductions have disappeared, some key deductions are still around. The state and local tax deduction, or the SALT deduction. It's now capped at $10,000. And then there's the mortgage interest deduction, the deduction for charitable contributions, which now has a higher limit of 60% of adjusted gross income, and of course, medical expense deductions. All right, moving on to number 3. Could you ramp up your 401k or 403b contributions? Contributions to these retirement plans may lower your yearly gross income. If you lower your gross income enough, you might be able to qualify for other tax credits or breaks available to those under certain income limits. Note that contributions to Roth 401ks and Roth 403bs are made with after-tax rather than pre-tax dollars. So contributions to those accounts are not deductible and will not lower your taxable income for the year. All right, and that brings us to number 4. Are you thinking about gifting? How about donating to a qualified charity or nonprofit organization before 2019 ends? Your gift may qualify as a tax deduction. You must itemize deductions using Schedule A to claim a deduction for a charitable gift. And while we're on the topic of estate strategy, why not take a moment to review your beneficiary designations? If you haven't reviewed them for a decade or more, which I see far too often, double check to see that these assets will go where you want them to go should the unfortunate event happen and you pass away. Lastly, look at your will to see that it remains valid and up to date. All right, moving on to number 6. Can you take advantage of the American Opportunity Tax Credit, or the AOTC? The AOTC allows individuals whose modified adjusted gross income is $80,000 or less, and joint filers with income of $160,000 or less a chance to claim a credit of up to $2,500 for qualified college expenses. Phase-outs kick in above those income levels. And number 7, see that you have withheld the right amount from your paycheck. If you discover that you have withheld too little on your W-4 form so far this year, you may need to adjust your withholding before the year ends. What can you do before ringing in the new year? Talk with a financial or tax professional now rather than in February or March. Little year-end moves might help you improve your short-term and long-term financial situation. That's it for today. I'll look for you next time. Thanks. Hey, this is Eric again. I want to thank you for taking a few minutes with me here today. Did you find value in today's message? If so, please help me help others and share it. Want more ideas for making the most of your financial future? There are a lot of ways, and I'd love to help. Be sure to subscribe here and then go visit me online at www.erichagen.pro. I hope to see you around.